Welcome to the world of financial trading. In this lesson, we're going to be talking about something called contract size. But first, let's define what we mean by a contract in the context of trading. Imagine you're at a farmer's market, and you want to buy some apples. You approach the farmer to ask, "How are your apples sold?" The farmer says, "Apples are $1 each, but all apples at this market are sold in baskets of 10. If you buy a basket, you will be receiving 10 apples." The farmer then responds, "All right, that'll be $10. At this point, you and the farmer have entered into a contract. You have agreed to buy a certain quantity of apples for a certain price. The quantity of apples is called the contract size. Now, let's bring this concept over to the world of financial trading. When you trade stocks, commodities, or other financial instruments, you are also entering into contracts. Just like at the farmer's market, the contract size refers to the quantity of the asset being bought or sold. But here's where it gets a little more complicated. Different exchanges have different standardized contract sizes for different assets. For example, on the New York Stock Exchange, the contract size for trading a single share of stock is 1 share. On the New York Mercantile Exchange, the contract size for trading crude oil futures is 1,000 barrels. And on the Intercontinental Exchange, the contract size for trading coffee futures is 37,500 pounds. So, to sum it up, the contract size is the quantity of an asset being bought or sold in a financial contract. It is important to understand the contract size of the asset you are trading, as it can affect the potential profit or loss of your trade.